Hello, I'm going to go over account classifications with you. So if you have any questions after watching the video, just ask me in class. All right, so first we're going to look at class accounts that fall in the income statement. So we're looking mainly at revenues and expense accounts. So revenues is an amount earned from rendering service or transferring resources to customers. So think of a business that sells merchandise. They're providing you with a product. If I'm maybe installing a new roof on your house, that would be considered a service. And so in accounting, we have different types of names for those things. And so sales is when I'm selling a product, a tangible item. My revenue account that I would use would be called sales. If I was providing a service, we call that service fees. So these are the revenue account names that we use for those two pieces. Sometimes businesses provide subscriptions, and so if you're paying a monthly subscription, the business will classify that as subscription revenue. If a business has existing office space that they may want to rent out, that will be called rent revenue. So let's say I'm an insurance agent in town, and I have excess space, and I want to rent out to other business professionals. As they pay me rent, that would be considered a revenue on my behalf, so we call that rent revenue. All right, let's look at expenses. Expenses are an amount incurred from using resources or services in the effort to generate revenue. So whenever we use up, and we'll get to this in a second, whenever we use up our assets or we use services, we generate expenses for our business. So some common classifications, accounts that go with expenses is basically anything that ends with expense. So rent expense, if I'm a business and I am paying a lease, rent expense would be one. Insurance expense, so businesses have to insure themselves, so that would be insurance expense. Utility expense, paying utilities, electricity, gas, garbage, whatever types of utilities they incur. And then this one is cost of goods sold. So all of them pretty much have the word expense except for cost of goods sold. So cost of goods sold, if I'm selling merchandise, let's say I buy the merchandise from a supplier for, let's say, $1, and I turn around and I sell it to my customer for $1.20. Well, I recognize the revenue of $1.20, but the cost of goods sold is I paid $1 to get that merchandise. So when I sell off that merchandise, I create a cost of goods sold, and that'll make more sense as we kind of look at the income statement. Most beginning accounting students forget about cost of goods sold. And they can't forget about it because it's usually one of your largest expenses in terms of dollars if you're selling merchandise. Supplies expense. So businesses buy supplies that they use up in the running of their business. And so supplies expense is an expense that they would see. Don't get it confused with inventory expense because there's no such thing as inventory expense. Remember, when you sell your inventory, you're creating a cost of goods sold. When you use up your supplies in running of your business, that's a supplies expense. All right, so those are revenue and expense accounts. Those are found on the income statement. And now we're going to look at the balance sheet classifications. The first one we're going to look at are assets. Assets are the right to use resources that have expected future economic benefits. So basically, assets are going to help us kind of generate revenues in the future. There's some type of economic benefit we'll receive from these assets. And so basically, we break up assets into two classifications. One is current assets, and the second one is property, plant, and equipment. So current assets are viewed as we're going to use in the upcoming accounting year cycle. Property, plant, and equipment we're going to generally use up beyond the current cycle. So we have the property, plant, and equipment for multiple years. When we look at current assets going back in the beginning of our country, when we wanted to build railroads, banks were the ones that kind of gave loans to the railroad companies. And banks at the time were very, very conservative. So what they wanted to see, they wanted to look at the railroad company's assets. And they wanted to see it in order of liquidity. So liquidity means how quickly can you take an asset and turn it into cash. So when we look at a balance sheet and we look at current assets, it's always listed in order of liquidity, with the first one being cash. So cash is obviously the most liquid because it is already cash. So think about a business having checking accounts and the money that they have in those accounts. The second one would be short-term investments. So a lot of times businesses have excess cash laying around and they don't want to just leave it sitting in an account earning no interest. So some businesses will take their excess cash and put it into short-term investments where they could get a higher return on the money. So that's considered a current asset. The third one is accounts receivable. And so a receivable is when your customer owes you money. Now, when you go to the store and buy something, you basically pay for it right at the spot. Well, when businesses do business with other businesses, they basically provide stuff on account. So what that means is, let's say I'm buying lumber. I build wooden clocks, and I'm buying lumber from a lumber yard. Well, they're going to send me the lumber, and then they're going to send me a bill with that. So I don't necessarily pay them right on the spot. So on their end, the lumber yard, they have accounts receivable. All right, so the customer owes them money. So when the customer owes you money, you have what is called an accounts receivable. Prepaid rent. So businesses, when they go to rent space, they pay their rent for usually a year in advance, maybe 6 months in advance. So they're prepaying the rent even though they haven't used it yet. So that prepaid rent that they pay for future months is considered a current asset. They're going to use that asset up, and it's providing a future economic benefit. The next one are supplies, and I talked a little bit about this before with supplies expense, but supplies of running my business, the supplies that I use, maybe if I'm manufacturing a product, I might need oil for my machines. So the oil that I use to kind of keep the machines running smoothly, that oil would be considered supplies. It's not going into the product. It's used in the making of the product. And we'll talk a lot about that in Module 4. The last one that I'm going to talk about here is inventory. So inventory is the merchandise that I'm selling. So if I'm let's say I'm Walmart and I'm buying, Walmart sells, let's say, school supplies. So they're carrying all the different school supplies on their shelves. So when they have to get that from a supplier, and so when they buy it to resell it, that's considered inventory. So a lot of beginning accounting students get inventory and supplies confused. Just think that inventory is the stuff that you're selling. Supplies are the resources that you're kind of using up in the course of running your business or running your manufacturing facility. All right, let's look at the long-term assets. The long-term assets are property, plant, and equipment. So you have the most common one you'll see on a lot of companies is the building account. When we buy a factory, we have the building and then we have the land. So we break apart the value of the land, and so land's going to hold a value, and then the building's going to hold a value. And those accounts are treated separately. Equipment, so just think of all the equipment that a manufacturing company has, even a service-based business will have a lot of equipment floating around. So equipment is considered a long-term asset because you're going to have it more than one accounting period. And then another one like van, you're going to have trucks, delivery vehicles, whatever the business decides to call, those are considered long-term assets. All right, so let's move on to the next one. So there they all are. The next one we're going to look at is liabilities. Liabilities are the obligation to transfer economic resources to suppliers of goods and services at some point in the future. So the basic way of just thinking of a liability is you owe. Just think of you owe someone something. You owe them either money or you owe them work. And so a liability, just think of that way. And in liabilities, we do kind of something similar where we have current liabilities and long-term liabilities. So liabilities that are due within the current period go into current. If it's more than 1 year, it goes into long-term. So if we look at current liabilities, the first one I have here are accounts payable. If I, going back to my lumber example, if I buy lumber to make my clocks, I'm going to, on my end, remember on the lumber yard, they have a receivable. On my end, I have a payable. So now I owe money to the lumber yard, so that's an accounts payable. So we keep track of all of our accounts payable to all of our suppliers. Secondly, we borrow money from the bank, so that would be a bank note payable. So right now, if you look at the two words there, they both have in common, they're both payables. So whenever you see a payable, think liability. The third one is interest payable. So when we borrow money, we also might owe interest on the money that we borrow, so it's interest payable. Don't confuse it with bank note payable. Bank note payable is the principal that I'm borrowing. Interest payable is the interest that I owe on the money that I borrowed. So those are two separate accounts. Unearned service fee. So if I, let's say I'm fixing the roof on your house, and it's going to cost $15,000, I'm going to collect $7,000 up front from you, and then I'm going to set a date where I'm going to come and fix your roof. So right now I collected $7,000 from you, so that I owe you $7,000 worth of work. So that's going to go in the unearned service fee. So some service-based companies will collect money up front, and now they owe you that work, and so that's a liability. So you could either owe money or you could owe the work. And another name for it's unearned revenue. So you might see it as unearned service fee, unearned revenue. Different businesses use those two interchangeably. Long-term liabilities more than 1 year. So a bank note payable, I could owe the bank beyond the year. So think about your parents, and they might have a mortgage on a house, and so they owe that money beyond the upcoming year. There's money that they're going to owe, so that would become a long-term liability. And same thing with interest. The interest could potentially be a long-term liability also. All right, the next one we're going to look at, and the final classification, is owner's equity. And this one represents the claim of the businesses to transfer interest to the owners. So just think, assets minus liabilities gives you your net worth. Your net assets is another name for it. And the only two accounts that we're going to kind of introduce now are retained earnings and common stock. So think of retained earnings as net income that is basically retained by the company. If I make $1 million and I own the donut shop down the street, I could either put the $1 million back into my business, or I could take some money out to live off of, which most businesses will do. So if a company has a net income, a positive net income, they will retain some of that money back into the company. They might pay some out in the form of a dividend, which we'll talk about later. But think of retained earnings, the best way to define this, and you want to write it down, it's cumulative net income retained by the company. So it's cumulative going back to the beginning of the company. How much income did they retain back in? So for example, if year one we made $1 and we keep the whole $1, our retained earnings account will hold $1. Year two, let's say we have a net income of $3. We're retaining all $3. Now our retained earning balance goes up to $4. And let's say next year we make $9 and we're going to pay $3 out in the form of dividend. We're going to retain $6. So now 6 plus 4 is 10. So retained earnings, just think it's cumulative net income retained by the company. Then you have the common stock account. So the common stock account is when I sell equity in my company, I'm using that money to finance, that cash to finance my business. So common stock is an equity account. So where you want to be, you want to make sure that you understand the accounts I just highlighted and which classification they fall under, and kind of study that to begin with.